Hey there, everyone. Welcome back to my growth portfolio series. In the previous videos, we went over what ETFs that I'm investing in and why I chose the ones that I did. I do have two general strategies in how I'll be using this portfolio in order to make money, and in this video, I'll go ahead and explain it in detail. Also, when I woke up today, I saw that there was a ton of videos, Reddit posts, Twitter comments about the latest of the Chinese market regulations and the Chinese government. So let's go ahead and talk about it. First, I just want to address that, the various ETFs that hold non-US stocks, namely stocks belonging to Chinese companies. I bet you're expecting like a really long rant or conversation about those Chinese companies and the Chinese government. But for this video, I'm just going to go ahead and keep it simple, since as they said in the military, KISS, or keep it simple, stupid. You see, when you invest in any company, no matter where they are located, you are taking a certain amount of geopolitical risk, since we don't live in a capitalistic society. I know it may seem like that at times, especially with how pervasive lobbying is, but the underlying governments around the world are not capitalistic. We have representative democracies, monarchies, socialist governments, communist governments, you name it. What we don't have, though, is a capitalist government. Alright, so in essence, there will always be risks of governments cracking down on corporations. How you measure that risk and how you try to mitigate that risk, it's up to you. Since, of course, I'm not your financial advisor or even a financial advisor in general. But enough about this. Let's go ahead. We'll jump into M1 and talk about how I plan on realizing the profits that come from my growth portfolio. Alright, so first we have my 80-20 split strategy. This is actually just a yearly rebalance where I take the total amount of both portfolios that I own and I multiply that by 20%. Then I'll subtract the value of that from this portfolio from that amount, and then I'll sell out of that amount and transfer it to my main dividend portfolio. It sounds complicated, but it's not. For example, the value of both of my portfolios comes out to be, as of yesterday, $8,842.28. If you use M1, you can get the value of your total investments, your spend account, as well as how much you've borrowed on margin by going to the Transfers tab. So by multiplying the total investment amount by 20%, I can see that the total value of, let me pull up our trusty calculator here. So if we 8842.28 times 0.2, it's 20%. So you can see that the total value of this portfolio should be $1,768.46 because we round. So what we do is, if we want to, let's say this is the end of the year and I'm rebalancing, I just subtract the total amount of the growth portfolio, 2212.78, and that is how much that I should sell out of my growth portfolio at the end of the year, $444.32. Of that, I'll transfer over to my dividend portfolio and add that to that portfolio. And that's if I, did the yearly rebalance as of today. roughly 7, 8, 9, 10, 11, 12, roughly 5 months early. Now, the second strategy is actually the long-term growth strategy where I realize the profits gained from this portfolio. Every 5 years, I plan on taking money off the table, as the saying goes, also known as realizing my profits. What that means is that I'll sell off the amount of unrealized gains that I've gotten in those 5 years. We can actually get that amount by going to the Holdings tab. And here we can see the amount of positions that we currently have, the cost basis of the total portfolio, its current value, as well as the unrealized gains. So as of today, the 27th, which is Tuesday, you can actually see that this total portfolio is down by $13.13. That's fine. Alright, so do I expect the overall portfolio to go parabolic and go to the moon? I actually don't, should I expect an ETF to have that type of price movement due to the amount of holdings that they typically have. Other than the ARK ETFs, I also can't expect for the fund managers of those ETFs to put in very risky startups into their funds, since there's only a really small potential in those startups to make it big. Not all startups, not all IPOs will ever go, 5,000% or anything like that. And also, I would haphazard to guess that most of their investors that are buying into those ETFs, they're looking to minimize risk, not increase their risk. So with that said, though, I do expect that this portfolio will at least be on par with the general stock market if my investment thesis is wrong. But if my thesis and future predictions are correct, then this portfolio should outperform the market by a very decent margin. So that is pretty much it in a nutshell. And I know this is just a short video, but if you have any content ideas or want me to do any further explanations on any of these ETFs, let me know in the comments section down below. But for now, though, what I'm thinking is that we'll go ahead and revisit this portfolio about once a quarter or so, just to see how well it is done during that quarter. But I'll go ahead and I'll see you then. Bye now.